The prototype settlement instrument known as the Unit, launched in a controlled pilot phase in late October 2025 and detailed further in November announcements, introduces a blockchain-based mechanism partially anchored to physical gold amid record-high precious metals valuations exceeding $4,530 per ounce. Structured with 40% gold backing and 60% a basket of core BRICS currencies, this digital unit of account targets wholesale cross-border trade settlement within the expanded bloc of 10 members. As intra-bloc transactions increasingly incorporate alternative channels, the initiative advances efforts to internalize payment flows outside traditional dollar infrastructure. Combined with sustained reserve diversification and geopolitical fragmentation, this development underscores evolving preferences in global trade finance, raising questions about the long-term transactional utility of established reserve currencies in multipolar commodity and bilateral exchanges. As of December 27, 2025, the operational rollout of the BRICS Unit pilot program, initiated in late October with an initial batch of controlled transactions, and refined through subsequent technical iterations in November and early December, establishes a foundational framework for gold-anchored digital settlement in intra-block trade, leveraging blockchain infrastructure to facilitate wholesale clearances independent of legacy financial networks. The instrument's design incorporates a hybrid valuation model, with 40% derived from verifiable physical gold reserves distributed across secure member state vaults, and the remaining 60% tied to a balanced basket of founding currencies: the Brazilian real, Chinese yuan, Indian rupee, Russian ruble, and South African rand, subject to daily recalibrations that reflect spot market dynamics and exchange rate fluctuations. This structure addresses inherent volatility in pure fiat-based systems by embedding gold's intrinsic stability, enabling efficient netting of bilateral and multilateral trade imbalances without recourse to intermediary conversions that inflate costs by an estimated 2–3% per transaction in conventional setups. For the expanded BRICS consortium, now encompassing 10 full members including recent inductees like Indonesia and the United Arab Emirates, the unit's architecture proves particularly adept at handling commodity-dominant flows, which constitute over 60% of intra-block exchanges in sectors such as energy pipelines from Russia to China, mineral exports from South Africa to India, and agricultural shipments across the group. The partial gold backing enhances cross-jurisdictional acceptability, serving as a neutral bridge asset that navigates divergent monetary policies, ranging from China's accommodative liquidity injections to India's inflation-targeting regime, while circumventing unilateral restrictions imposed on traditional payment rails, such as those stemming from secondary sanctions or compliance mandates in Western-dominated systems. Early implementation phases have prioritized batch processing to test operational resilience, with reported success in simulating high-volume scenarios involving up to 500 million equivalent units in netted obligations, laying groundwork for phased scaling to include observer and partner networks by mid-2026. The integration of physical gold collateral not only stabilizes the unit's daily pricing mechanism, but also reinforces structural demand pressures in precious metals markets, where annual global supply has plateaued around 3,536,000 tons amid maturing mine yields and regulatory hurdles in new project developments. BRICS-aligned entities, controlling approximately 45–50% of worldwide gold production through major operators in China, Russia, and South Africa, exercise significant influence over physical flows, enabling strategic retention policies that divert output from open markets to bolster collateral pools without exacerbating import dependencies for non-producing members. This retention dynamic complements the bloc's official accumulation trajectory, which has surpassed 800 tons in net additions during 2025, pushing aggregate holdings beyond 6,000 tons and elevating gold's share in reserves to 18–20% on average across the group. The unit's 40% gold linkage transforms the metal from a static reserve component into an active transactional enabler, sustaining bid-side pressure in key Asian pricing hubs like the Shanghai Gold Exchange, where physical delivery premiums have widened by 1–2% over spot levels since the pilot's announcement, reflecting heightened settlement-related demand. For central bank reserve managers operating in environments marked by sanction vulnerabilities, such as those faced by Russia and Iran, The mechanism offers a non-disruptive pathway to monetize holdings, allowing collateral pledges that generate liquidity equivalents without triggering large-scale sales that could depress valuations during thin trading periods, as observed in late December sessions. This reinforcing loop, wherein pilot adoption incentivizes further gold procurement to maintain backing ratios, supports durable pricing floors above $4,500 per ounce, compatible with the unit's collateral integrity and resilient to exogenous shocks like commodity cycle downturns or abrupt policy shifts in major economies. From a macroeconomic vantage, the unit's deployment intersects with broader trends in global trade finance fragmentation, where intra-BRICS volumes, now approaching 15% of world merchandise trade on nominal terms, benefit from reduced exposure to dollar liquidity squeezes, particularly amid the U.S. Federal Reserve's ongoing balance sheet normalization that has contracted broad money measures by 4% year-over-year. The blockchain substrate, initially built on scalable protocols with audit trails ensuring immutability, minimizes settlement risks associated with correspondent banking delays, which have historically extended clearance times to 2-3 business days in cross-border deals, thereby enhancing capital efficiency for exporters in energy and raw materials. In commodity-heavy corridors, the gold anchor mitigates basis risks between volatile fiat components and physical asset values, fostering greater participation from state-owned enterprises that dominate these flows, such as China's Sinopec or Russia's Gazprom, which have piloted unit-based netting in select contracts since November. The architecture's focus on wholesale applications avoids retail-level complexities, concentrating instead on institutional clearances that could encompass up to 20% of block trade by 2027 if scalability benchmarks are met, drawing on lessons from prior bilateral arrangements that have already shifted 90–95% of Russia-China exchanges to non-dollar denominations. Reserve management implications are equally pronounced, as the unit's gold integration prompts a reevaluation of allocation strategies among member institutions, where traditional dollar-denominated assets, comprising 50–60% of emerging market portfolios, face diminishing returns in a low real yield environment, with U.S. 10-year Treasuries offering inflation-adjusted rates below 1%. By distributing collateral across decentralized vaults, the system disperses custody risks, aligning with repatriation efforts that have seen hundreds of tons relocated from overseas depositories to domestic facilities over the past year, thereby enhancing sovereignty over strategic reserves. This dispersal also amplifies liquidity premia in regional markets, where Asian investors, accounting for 60% of global physical demand, interface with settlement protocols that prioritize verifiable delivery, potentially compressing spreads between London fixes and local benchmarks by 0.51% as adoption matures. Geopolitically, the pilot's emphasis on circumvention capabilities addresses asymmetries in financial infrastructure access, particularly for members navigating export controls or asset freeze precedents, fostering a self-contained ecosystem that internalizes payment risks without reliance on external validators. The balanced currency basket component, while introducing modest volatility tied to member-specific inflation differentials, ranging from 2% in China to 6% in Brazil, benefits from gold's stabilizing overlay, ensuring the unit's viability as a transitional tool toward fuller multilateralism. Operational testing in controlled batches has revealed robustness against simulated disruptions, such as network latency or valuation spikes, with recovery protocols drawing on redundant blockchain nodes distributed across continents. Supply-side dynamics further entrench the gold backing's efficacy as constrained mine output, impacted by environmental regulations in key jurisdictions like Australia and Canada, which indirectly benefit BRICS producers through relative market share gains, underscores the bloc's leverage in dictating retention quotas. Official accumulation trends, driven by diversification imperatives amid a 9% depreciation in the dollar index this year, create a self-sustaining demand floor that aligns with the unit's collateral needs, potentially elevating annual procurement requirements by 100–200 tons if transaction volumes scale as projected. Portfolio strategists must contend with these shifts, where underallocated gold positions in conventional mandates risk underperformance against benchmarks incorporating emerging market weights, prompting incremental shifts that could add 1–2% to annualized returns over 5-year horizons. For corporate entities embedded in block supply chains, the unit offers hedging avenues against currency mismatches, reducing forward contract premiums by integrating gold-linked stability. The interplay between digital settlement innovation and physical asset anchoring exemplifies a maturing multipolar financial order, where the unit's pilot not only verifies technical feasibility but also signals strategic intent to recalibrate global liquidity dependencies. As year-end assessments unfold, monitoring uptake metrics, such as netted volumes and participant feedback, will inform projections for broader implementation, with potential ramifications for currency market equilibria and trade finance costs extending into the foreseeable future. Extending the analysis to systemic liquidity considerations, the unit's design mitigates fragmentation risks in global payments by providing a scalable alternative for high-value clearances, particularly in energy trades where price volatility necessitates robust anchoring. The 40% gold threshold, calibrated to balance stability with flexibility, draws on historical precedents like special drawing rights but innovates through blockchain transparency, reducing dispute incidences that plague traditional systems. In reserve diversification contexts, the mechanism's indirect monetization features allow for dynamic asset utilization, where pledged gold generates yield equivalents through settlement efficiencies, bolstering fiscal buffers in commodity exporting members amid subdued global growth forecasts hovering around 3% for 2026. Market pricing responses since the pilot's inception have included widened physical premiums in Shanghai, reflecting anticipatory demand from institutional players positioning for expanded adoption, while COMEX futures exhibit increased backwardation, indicative of near-term supply tightness aligned with BRICS retention strategies. For international investors, the development warrants portfolio adjustments, as elevated gold floors support diversification benefits with correlations to equities dropping below 0.2 in recent quarters, offering tail risk protection in deglobalizing environments. The unit's evolution from prototype to potential standard underscores a deliberate pivot toward resilient trade architectures, with gold's role pivotal in bridging monetary divergences and sustaining momentum amid geopolitical headwinds. Character count 9,856. As of December 27, 2025, the incorporation of a 40% physical gold collateral requirement within the BRICS Unit prototype settlement instrument, distributed across verified member state vaults and calibrated against daily market valuations, elevates gold's functional role from a traditional reserve asset to an integral component of active transactional support in cross-border trade clearances. This structural linkage, embedded in the pilot program launched on October 31, 2025, with an initial issuance of 100 units each pegged to approximately 1 gram of gold, adjusted dynamically to reflect spot fluctuations, sustains persistent bid pressure in physical gold markets, where annual global mine production remains constrained at an estimated 3,300 to 3,661 tons. Falling short of combined official and investment demand thresholds that have exceeded 4,000 tons in recent quarters per World Gold Council assessments. Unit's design, blending gold's intrinsic value with a 60% basket of core BRICS currencies, facilitates wholesale netting for commodity-intensive flows without intermediary exposures, thereby reinforcing demand dynamics that have propelled spot prices to sustain levels above $4,500 per ounce, with recent fixes ranging from $4,483 to $4,532 amid thin year-end trading volumes. For BRICS-aligned producers, who collectively command around 45% of worldwide output through major operations in China, Russia, and South Africa, this integration enables strategic retention of newly mined volumes, diverting supplies from open market auctions to collateral pools that underpin the unit's stability, complementing official accumulation patterns that have added over 800 metric tons to block reserves this year alone, pushing aggregate holdings beyond 6,000 tons as reported in national disclosures and IMF compilations. This retention strategy not only mitigates supply-side pressures, but also amplifies liquidity premia in key Asian pricing centers, such as the Shanghai Gold Exchange, where physical delivery mechanisms increasingly interface with settlement protocols tailored to the unit's requirements, resulting in premium expansions of 1–2% over London benchmarks since the pilot's inception. Reserve managers within the expanded bloc, now including Egypt, Ethiopia, Indonesia, Iran, and the United Arab Emirates, benefit from this mechanism's indirect monetization features, allowing pledged gold allocations to generate effective liquidity without necessitating large-scale disposals that could induce volatility in already elevated markets, particularly in sanction-constrained environments where access to dollar-denominated funding remains episodic. The reinforcing dynamic established herein, whereby broader pilot adoption incentivizes further procurement to maintain backing ratios amid growing intrablock trade volumes, estimated at 15–20% of global merchandise flows, supports durable pricing floors compatible with collateral integrity, as evidenced by the metal's 72.95% year-to-date appreciation against a backdrop of depreciating reserve currencies. From a macroeconomic perspective, the partial gold backing intersects with divergent policy trajectories across the bloc, where accommodative measures in China, evident in liquidity injections sustaining domestic consumption, contrast with tighter frameworks in India, yet the gold anchor provides a neutral stabilizer that mitigates basket volatility, ensuring the unit's viability for energy and mineral settlements that dominate exchanges like Russia-China pipelines or South Africa-India ore transfers. Global supply constraints, exacerbated by maturing yields in legacy mines and regulatory delays in new developments across non-BRICS jurisdictions such as Australia and Canada, underscore the bloc's relative market share gains, enabling production quotas that prioritize domestic retention and reduce export dependencies for importers within the group. This control over output flows, quantified at approximately 1,500 tons annually from BRICS sources, creates a self-sustaining loop wherein collateral demands from the unit's scaling, projected to encompass up to 500 million equivalent units in simulated high-volume tests, further entrench bid-side resilience. Counteracting potential downward pressures from seasonal recycling surges that have stabilized at 1,213 tons per annum. Reserve diversification imperatives amplify this effect, as the bloc's holdings, led by Russia's 2,336 tons, China's 2,298 tons, and India's 880 tons, represent a strategic pivot away from overexposure to U.S. Treasury securities, whose real yields have compressed below 1% amid persistent inflation readings averaging 3–4% across G20 economies. The unit's vault-distributed collateral model disperses custody risks, aligning with repatriation initiatives that have relocated hundreds of tons from overseas depositories to sovereign facilities, thereby enhancing autonomy in asset management and reducing vulnerabilities to jurisdictional freezes, as observed in prior geopolitical episodes. For corporate entities embedded in block supply chains, this linkage introduces hedging efficiencies, where gold-backed settlements minimize basis risks in volatile commodity pricing, potentially lowering forward contract costs by 1–2% in energy deals denominated outside traditional currencies. Geopolitical fragmentation further entrenches the gold backing's relevance, as the unit's architecture addresses asymmetries in financial infrastructure, enabling clearances insulated from compliance mandates that have disrupted conventional rails for members facing secondary sanctions. The 40% threshold, informed by historical basket constructs like special drawing rights, but innovated through blockchain auditability, balances rigidity with adaptability, ensuring daily adjustments prevent misalignments during currency asymmetries, such as the 6% inflation differential between Brazil and China, that could otherwise erode participant trust. Operational resilience testing in batch phases has demonstrated robustness against simulated disruptions, including valuation spikes tied to gold's intraday volatility, with recovery protocols leveraging redundant nodes to maintain continuity in multilateral netting. Portfolio strategists confronting these developments must reassess allocations, where underweight gold positions in dollar-centric mandates risk relative underperformance, given the metal's low equity correlations, dropping below 0.2 in recent quarters, and tail risk protection amid deglobalizing trade patterns. Sovereign wealth funds within the bloc, managing trillions in assets, increasingly incorporate unit-linked exposures to optimize returns, yielding incremental gains of 2–3% annualized over diversified benchmarks. Market responses since October have included backwardation in COMEX futures, signaling near-term tightness aligned with retention policies, while physical premia in Shanghai reflect anticipatory institutional positioning for expanded adoption. The broader implications for global monetary equilibria are measured yet significant, as the unit's gold integration contributes to a reconfiguration of liquidity hierarchies, where alternative anchors gain traction in proportion to rerouted trade flows, diminishing marginal reliance on established reserve currencies. As year-end liquidity thins, monitoring collateral procurement metrics, such as quarterly additions and vault verifications, will be essential for gauging sustainability, with potential spillovers into currency volatility if scaling accelerates amid unresolved commodity disputes. Extending to systemic stability, the backing reinforces gold's anti-inflationary credentials in an environment of subdued global growth projections around 3% for 2026, providing bloc members with fiscal buffers against export revenue swings. For net importers like India, sustained high prices elevate input costs, necessitating prudent hedging, while producers like Russia leverage output dominance to fund domestic priorities without market dilution. In commodity finance, the linkage facilitates collateralized lending facilities, where pledged gold generates yield equivalents through settlement efficiencies, bolstering balance sheets in high-debt contexts. The pilot's success in energy corridors, netting volumes equivalent to billions in bilateral deals, exemplifies this utility, reducing transaction frictions that have historically added 2–3% to effective costs. International investors navigating these shifts face heightened imperatives for diversification, as gold's elevated floors, sustained by unit demands, offer asymmetric upside in multipolar regimes, prompting tactical reallocations that could absorb 100–200 tons annually from open markets. The evolution of this mechanism, from conceptual prototype to operational pilot, signals a deliberate enhancement of financial sovereignty, with gold's role pivotal in sustaining momentum against headwinds like supply stagnation and policy divergences. As of December 27, 2025, the gradual realignment of settlement preferences within the BRICS bloc, validated through the ongoing pilot of the unit settlement instrument since its initiation on October 31, 2025, and subsequent testing phases extending into early December, introduces measurable risks to the dollar's entrenched share in global trade invoicing, as intrablock volumes, now encompassing approximately 15–20% of worldwide merchandise trade, begin to reroute through alternative clearing mechanisms independent of correspondent banking networks. This migration, building on established bilateral local currency agreements that have already achieved dominance in corridors such as Russia-China energy transactions, where non-dollar settlements exceed 95% of flows according to national central bank reports, incrementally diminishes marginal demand for dollars in commodity pricing benchmarks, particularly for oil, metals, and agricultural staples that form the backbone of emerging market exchanges. Combined with accelerating reserve reallocation trends, evidenced by BRICS central banks adding over 800 tons of gold to holdings this year, elevating aggregate reserves beyond 6,000 tons, and the proliferation of parallel digital platforms like national central bank digital currencies in China and Russia, the initiative highlights contingent vulnerabilities in currency market liquidity, especially during periods of financial stress when dollar funding premia could widen abruptly if rerouted volumes scale. While current adoption remains deliberately measured and confined to wholesale applications, with initial batches processing simulated transactions equivalent to hundreds of millions in value, the potential for expansion among geopolitically aligned partner nations, numbering over 20 prospective members facing analogous constraints on Western infrastructure access, could accentuate volatility in offshore dollar markets, prompting institutional reassessments of hedging strategies for exposures tethered to legacy systems that have historically commanded 60–70% of international invoicing. The unit's hybrid structure, anchored by 40% physical gold collateral and 60% a basket of core BRICS currencies, facilitates this shift by offering a stable, blockchain-enabled alternative for multilateral netting, reducing transactional costs associated with foreign exchange conversions and compliance overheads in traditional rails. This architectural choice aligns with broader de-dollarization efforts, where member states have progressively increased local currency usage in bilateral trade. As confirmed by Egyptian Prime Minister Mostafa Madbouly's July 2025 statement noting heightened adoption across the bloc, thereby eroding the dollar's incremental utility in pricing mechanisms for commodities like crude oil, where Saudi Arabia has expanded settlements in yuan and rupees since mid-2024. In practical terms, the pilot's validation through controlled environments, issuing 100 units initially pegged to 1 gram of gold each, with reserves distributed across member vaults, demonstrates operational feasibility for rerouting flows that represent a growing segment of global trade, estimated at 3.3 billion people within the bloc's economic sphere. Fostering a self-contained ecosystem that internalizes liquidity risks without reliance on dollar-denominated intermediaries. This incremental rerouting contributes to a subtle yet persistent decline in the dollar's trade invoicing share, which has already slipped from 80% in 2000 to around 60% by IMF metrics as of early 2025, accelerated by parallel initiatives like the New Development Bank's exploration of guarantee facilities for non-dollar settlements. Reserve reallocation dynamics amplify these risks, as BRICS institutions prioritize gold and local currency assets amid a depreciating dollar index, currently at 98.05, down 1.55% over the past month and over 9% year-to-date, reflecting weakened demand for dollar holdings in emerging portfolios. Brazil's resumption of gold purchases in September 2025, adding 16 tons to reach 145.1 tons, exemplifies this trend, aligning with collective efforts to mitigate exposure to sanction vulnerabilities and currency volatility that have prompted a rethinking of reserve composition since the 2022 asset freezes. Parallel digital platforms, including interoperability advancements among CBDCs like China's ECNY and Russia's digital ruble, further entrench this migration, enabling seamless integration with the unit for commodity trades that bypass SWIFT dependencies, thereby highlighting latent liquidity strains in dollar markets during stress events, such as those observed in March 2023, when funding costs spiked amid banking sector turbulence. The contingent nature of these vulnerabilities manifests in elevated hedging premiums for dollar-exposed positions, where forward contracts have seen basis spreads widen by 20-30 basis points in recent quarters for emerging market currencies. Adoption's measured pace, focused on wholesale clearances and not yet extending to retail or capital accounts, tempers immediate disruptions, yet the framework's scalability, as outlined in IRIAS announcements detailing blockchain-based transparency and daily valuation adjustments, positions it for broader uptake among partners navigating similar geopolitical constraints, including export controls and financial exclusion risks. This expansion potential could accentuate volatility in dollar funding markets, particularly offshore segments where eurodollar liquidity has contracted by 4% year-over-year amid Federal Reserve balance sheet normalization, prompting reassessments of strategies reliant on legacy infrastructure, such as dollar-denominated trade finance facilities that dominate 50–60% of global letters of credit. Institutional surveys indicate that 68% of emerging reserve managers now prioritize diversification amid these shifts, up from 45% in 2020, underscoring the need for forward-looking hedging that incorporates scenario analyses for accelerated rerouting in high-volume corridors like energy and minerals. From a systemic standpoint, the initiative's alignment with bilateral agreements, already routing 90% of Russia-China trade outside dollars, diminishes marginal dollar demand in commodity pricing over time, as evidenced by Saudi Arabia's diversification into non-dollar oil settlements, which have risen to 25% of exports since 2024. This temporal erosion intersects with gold's elevated valuations. Spot prices at $4,547.50 per ounce as of December 26, 2025, up 72.95% year-to-date, bolstering the unit's collateral appeal and indirectly pressuring dollar liquidity by sustaining alternative anchors that reduce transactional reliance on U.S. assets. Contingent vulnerabilities emerge in currency market dynamics, where stress periods could see dollar premia amplify if adoption scales, as simulated in recent central bank stress tests revealing potential 5,100 basis point spikes in offshore rates during capital flow reversals. Hedging reassessments thus become imperative for portfolios with legacy exposures, incorporating derivatives like cross-currency swaps that have seen volumes increase 15% in emerging markets this year. Portfolio implications extend to sovereign wealth funds and corporate treasuries, where dollar-centric mandates face revaluation pressures amid declining real yields on treasuries, below 1% inflation-adjusted, prompting shifts toward gold-linked instruments that offer asymmetric protection in multipolar regimes. The unit's pilot, by validating alternative clearing for intrablock volumes, contributes to this reconfiguration, with early indicators from batch testing suggesting capacity for 20% of block trade by 2027, aligning with BRICS Pay pilots projected through that horizon. This gradual integration highlights risks to the dollar's invoicing dominance, as commodity flows reroute, diminishing seigniorage benefits for the U.S. and elevating volatility in funding markets if partner expansions materialize amid unresolved trade frictions. Monitoring indicators, quarterly settlement disclosures, reserve composition updates, and platform interoperability milestones will be critical for assessing trajectory, as the shift's incremental nature belies its potential to reshape liquidity hierarchies over the medium term. In commodity-dependent economies, this migration buffers against dollar strength episodes, providing fiscal latitude, while importers contend with recalibrated pricing benchmarks that could inflate input costs by 2–3% in non-dollar terms. Corporate sectors, particularly in manufacturing and energy, must adapt hedging frameworks to incorporate unit-linked exposures, mitigating basis risks in divergent currency environments. The broader ramifications permeate global monetary equilibria, where the dollar's share in foreign exchange reserves, now at 58%, faces sustained pressure from diversification trends, potentially amplifying exchange rate swings if stress amplifies. As intrablock systems mature, the initiative underscores a deliberate pivot toward resilient architectures, with attendant implications for currency stability and trade finance extending into the foreseeable future.